Welcome back to Metal Market News. I'm Professor Harry, and as an independent analyst, my role is not just to repeat what's being said in the market, but to dissect it, challenge it, and align it with real macroeconomic and structural realities. What we're discussing today goes far beyond simple price movements in gold and silver. This is about understanding the difference between perception and reality, between paper markets and physical demand, and ultimately between short-term speculation and long-term value. The narrative you've just heard introduces a powerful argument that much of the volatility in gold and silver is not a reflection of weakness in the metals themselves, but rather a distortion created by speculative activity in derivatives markets. I'm going to break this down deeply, not only presenting the analyst's perspective, but also comparing it with my own independent view, so you can clearly see where the argument holds strength and where it requires caution. The core argument begins with the distinction between spot contracts and physical metals, which is one of the most misunderstood aspects of the precious metals market. The analyst emphasizes that what most people refer to as gold and silver prices are actually derived from spot contracts, which are heavily influenced by speculative trading rather than real-world supply and demand. This is absolutely correct at a structural level. Paper markets, particularly futures and derivatives, dominate price discovery in metals, and they can deviate significantly from physical fundamentals, especially during periods of high speculation. The example given, where silver moves 70% above its 200-day moving average, when a typical deviation might be closer to 10%, clearly illustrates an overstretched market condition driven by leveraged positions rather than organic demand. However, while I agree with the distinction, I would caution against completely separating paper and physical markets as if they operate independently. In reality, they are deeply interconnected. Paper markets may lead price discovery, but physical demand ultimately acts as a stabilizing force. The argument correctly identifies speculative excess, but it slightly underestimates how quickly sentiment in paper markets can spill over into physical pricing, and vice versa. The discussion then moves into the idea that physical demand for gold and silver remains intact despite volatility in prices, and this is used to counter claims of a bubble in the metals themselves. The analyst references the existence of global industrial users and consistent demand as proof that the intrinsic value of these metals has not diminished. This is a strong and valid point. Gold and silver are not purely speculative assets. They have real-world applications and long-standing roles as stores of value. However, where I would expand the analysis is in recognizing that demand alone does not dictate price in the short to medium term. Markets are driven by marginal buyers and sellers, and in highly financialized markets, that marginal activity often comes from institutional capital rather than industrial users. So while physical demand provides a floor, it does not prevent price volatility or even temporary mispricing. The critique of analysts who label gold and silver as bubbles, particularly those who fail to distinguish between derivatives and physical assets, is justified, but it should also be acknowledged that bubbles can form in any asset class when speculative capital dominates, regardless of underlying utility. As the narrative progresses, it challenges the notion of treasuries as a safe haven, arguing that their safety is purely nominal because governments can print money to repay them, thereby eroding purchasing power over time. This is a fundamentally important macroeconomic insight. Treasuries are often considered risk-free in nominal terms, but in real terms, they are highly sensitive to inflation. If inflation accelerates, the real return on these instruments can become deeply negative. I strongly agree with this perspective, especially in an environment where monetary expansion is persistent. However, the argument leans toward a more extreme conclusion, suggesting an inevitable collapse in purchasing power leading to hyperinflation. While this scenario is possible, it is not guaranteed. And history shows that developed economies tend to experience prolonged inflationary periods rather than sudden hyperinflation unless there is a complete breakdown in fiscal and monetary discipline. My view is that treasuries are not truly as safe in real terms, but they still play a critical role in the financial system particularly during periods of liquidity stress where capital seeks stability, even if temporarily. The hyperinflation scenario introduced, supported by examples like Venezuela, is used to illustrate how economic systems can transition toward alternative pricing mechanisms, including the use of gold and silver as units of account. This is a compelling argument from a theoretical standpoint. In extreme cases where confidence in fiat currency collapses, societies do revert to tangible stores of value. However, applying this model directly to major global economies requires careful consideration. Venezuela's situation was driven by a unique combination of political instability, economic mismanagement, and external pressures. While inflationary risks are present globally, the structural conditions in larger economies are different. That said, the underlying principle remains valid. As confidence in currency declines, the role of hard assets increases. My position is that while hyperinflation may not be imminent in all regions, the trend toward declining purchasing power is very real, and this gradually strengthens the case for holding tangible assets like gold and silver. The analysis also touches on a critical but often overlooked factor: energy costs and their impact on mining. This is an area where the argument becomes particularly strong. Mining is an energy-intensive process, and rising energy prices directly increase the cost of production for gold and silver. This creates a natural price floor as miners are unlikely to sell below their all-in sustaining costs. I fully agree with this perspective and would even emphasize it further. Energy is the backbone of all commodity production, and any disruption in energy markets has a cascading effect across the entire resource sector. The mention of geopolitical risks, such as disruptions in key transit routes, adds another layer of complexity. However, while rising costs can support prices, they do not guarantee upward movement. Demand must still be present to absorb supply at higher price levels. So while the cost argument strengthens the bullish case, it should be viewed as a supporting factor rather than a primary driver. Finally, the narrative expands into broader systemic concerns, including the role of digital assets like Bitcoin and the potential shift toward a new monetary system. The argument presented is highly skeptical of digital currencies, framing them as tools for increased financial surveillance, while advocating for a return to asset-backed systems centered on gold and silver. This is a perspective that reflects a growing sentiment among certain segments of the market. While I understand the concerns around control and surveillance, I take a more balanced view. Digital assets and traditional hard assets are not necessarily mutually exclusive. They can coexist within a diversified financial system. The idea of a global shift toward a gold-backed system is compelling but faces significant practical challenges, particularly in terms of implementation and political will. However, the underlying message is clear. Trust in fiat systems is being questioned, and investors are increasingly looking for alternatives that preserve value over time. This transition, whether gradual or abrupt, is likely to redefine how we think about money, risk, and wealth preservation in the years ahead.